Major financial institutions are starting to warn that the situation in the Middle East is no longer just a regional conflict. It is turning into something much bigger, and the pressure is now spreading through oil markets, bond markets, inflation expectations, and the broader US economy. The first warning sign is oil. The price of dated Brent, which is the real-world price paid for immediate physical delivery of North Sea oil, has started moving sharply higher. This matters because dated Brent is not just a futures contract on a screen. It reflects what buyers are paying for actual barrels of oil that can be delivered now. For most of this crisis, oil prices were being driven by traders, speculation, and fear. The market was trying to guess how bad the conflict could get. But now the situation appears to be moving into a different stage. We are no longer only talking about what traders think might happen. We are starting to see the real impact of supply problems. Physical oil is becoming harder to secure. Oil in transit is falling. Inventories are being drawn down. And if those supplies keep shrinking, the market could reach a point where the futures price has to catch up to the real-world shortage. That is where things become dangerous. When oil is available and prices rise because traders are nervous, the economy can absorb some of the shock. But when oil becomes physically harder to get, the market starts rationing through price. The buyers willing to pay the highest price get the supply. Everyone else gets squeezed. That squeeze is already showing up in certain parts of the world. Some gas stations are reportedly struggling to keep enough fuel available. Airlines could be next because jet fuel prices are extremely sensitive to supply disruptions. If jet fuel becomes too expensive or too difficult to secure, airlines may have to cut routes, reduce flights, or pass those costs directly on to travelers. This is why the oil market is so important. It does not stay isolated. Higher energy prices spread through the entire economy. Oil affects transportation, it affects food prices, it affects shipping, it affects manufacturing. It affects airlines, delivery companies, farmers, truckers, and consumers. When energy costs rise, almost everything else gets more expensive too. That is why recession odds are now rising. A prolonged oil shock can hit the economy in two ways at the same time. It can push inflation higher while also slowing growth. That is the worst possible combination because it leaves policymakers trapped. If they cut rates to help the economy, inflation can get worse. If they raise rates to fight inflation, the economy can weaken even faster. That is why the bond market is starting to look so stressed. The 10-year Treasury yield has climbed from below 4% before the Middle East conflict began to above 4.31%. That move may not sound massive at first, but in the bond market, it is a serious warning. Treasury yields affect nearly every major borrowing cost in the economy. Mortgages, auto loans, credit cards, corporate debt, and government interest expenses all feel the pressure when yields move higher. And now the government is facing weak demand for its debt at the worst possible time. Recent Treasury auctions have been ugly. Demand for $140 billion worth of 2-year and 5-year Treasury bonds came in weak, with the 5-year auction seeing its weakest demand in years. That is a problem because the US government needs constant buyers for its debt. The government is running massive deficits. It has to keep borrowing just to fund spending, refinance old debt, and cover interest costs. If investors demand higher yields to buy that debt, the government's interest bill gets even worse. Foreign central banks and institutions have also been selling US Treasuries for several consecutive weeks. In total, they have sold more than $82 billion during that period, bringing their overall holdings down to the lowest level since 2012. There are several possible reasons for this. Some countries may be selling treasuries because they need dollars to pay for more expensive oil imports. Others may be trying to defend their local currencies. Some may be rebalancing into other assets. But there's also a more troubling possibility. Foreign buyers may be getting more cautious about holding US dollar assets. If that is true, it would be a major problem. For decades, the US has benefited from the dollar's reserve currency status. Foreign governments, central banks, and institutions bought US treasuries because they were seen as safe, liquid, and reliable. That demand helped keep borrowing costs lower than they otherwise would have been. But if foreign demand weakens while the US keeps issuing more debt, someone has to step in and buy it. That is where the Federal Reserve comes in. When there are not enough natural buyers for government debt, the Fed can create new money and use it to buy treasuries. This is usually described as quantitative easing. But the basic idea is simple. The central bank expands its balance sheet and uses newly created money to support the bond market. In recent months, we have already seen signs of this process picking up again. Since the end of 2025, the Federal Reserve has been buying more U.S. Treasuries, especially short-term T-bills. That is a major reversal from the quantitative tightening trend we saw in 2024 and 2025, when the Fed was reducing its holdings instead of expanding them. Some mortgage-backed securities have been sold to help fund those Treasury purchases, but total Federal Reserve holdings have still risen from around $6.154 trillion to about $6.27 trillion in only a few months. That means the Fed's balance sheet has expanded by roughly $117 billion in about 90 days. At the same time, M2 money supply has also been accelerating. And this is before the full impact of the Middle East crisis has even worked its way through the financial system. That is why inflation expectations are rising so quickly. At the beginning of 2026, 12-month inflation expectations were below 2.5%. Now they have jumped above 5.2%. That is a massive shift. The bond market has gone from expecting more Fed rate cuts to now pricing in the possibility of multiple rate hikes. That tells you how fast the mood has changed. Just a few months ago, investors were focused on slowing growth and hoping the Fed would cut rates. Now they are worried about oil prices, money printing, inflation, weak Treasury demand, and the possibility that the Fed may have to tighten again even as the economy slows. This is how stagflation starts to enter the conversation. Stagflation is when inflation stays high while economic growth weakens. It is one of the most damaging environments because households get squeezed from both sides. Prices keep rising, but jobs and wages do not keep up. Businesses face higher costs, but customers have less money to spend. The government is also getting squeezed. The national debt is now above $39 trillion, and the annual interest cost is around $1.2 trillion. Roughly 20% of all federal tax revenue is already going toward interest payments on the debt. That means a huge share of government income is not being used for infrastructure, defense, healthcare, or services. It is simply being used to pay interest. And if yields keep rising, the situation gets worse. The government has a wall of debt that needs to be refinanced. Old debt issued at lower rates will eventually mature and be replaced with new debt at higher rates. That means the interest expense can keep climbing even if spending does not increase. This is the debt trap. Higher deficits require more borrowing requires more buyers. If buyers demand higher yields, interest costs rise. Higher interest costs make the deficit worse. Then the government has to borrow even more. That cycle is extremely difficult to escape, but the impact of higher bond yields does not stop with the government. Consumers feel it too. Mortgage rates briefly dropped below 6% earlier in the year, but now they have moved back up to around 6.46%. That hurts homebuyers immediately. Higher mortgage rates reduce affordability, lower buying power, and push more people out of the housing market. But this is not only a mortgage problem. Rising inflation makes it harder for people to save for a down payment. Higher food, fuel, insurance, and utility costs eat into household budgets, so buyers are hit twice. Their monthly mortgage payment goes up while their ability to save goes down. This is happening while the economy is already showing signs of weakness. Businesses are dealing with slower growth, higher costs, and more uncertainty. Many are hiring less, some are laying workers off, and if consumers begin cutting spending because their cost of living is rising, businesses will feel even more pressure. You can already see companies reacting. Amazon has added a 3.5% fuel and logistics charge for sellers to account for higher transportation costs. That cost will likely move through the system and eventually land on consumers in the form of higher prices. This is exactly how energy inflation spreads. It starts with fuel, then moves into shipping, then into retail prices, and finally into household budgets. Goldman Sachs economists are now warning that higher oil prices could reduce U.S. payroll growth by about 10,000 jobs per month through the end of 2026. They also expect unemployment to rise and recently cut their U.S. GDP growth forecast from 2.5% to 2.2%. That may not sound dramatic, but it matters because the direction is wrong. Growth is being revised lower while inflation risk is being revised higher. That is the perfect storm investors fear. Jamie Dimon has also warned that the U.S. debt situation is not sustainable. His point is simple. The government cannot keep borrowing endlessly without consequences. Adding trillions of dollars in debt every year eventually creates pressure somewhere, whether through higher rates, inflation, weaker confidence, or reduced flexibility in a crisis. Dimon has also warned about the second major risk, the breakdown of global trade relationships and the increasingly unstable geopolitical environment. The world is becoming more fragmented. Russia and China are moving closer together. Supply chains are being reshaped, capital flows are changing, companies are being forced to rethink where they invest and where they source critical materials. The US is still heavily dependent on other countries for important goods, including rare earth minerals and pharmaceutical ingredients. Some of those countries may not be friendly to US interests. That creates a national security risk and an economic risk at the same time. Larry Fink, the CEO of BlackRock, has issued a similar warning. He has said that if oil moves toward $150 per barrel and stays elevated, a global recession becomes much more likely. His concern is not just that oil could spike for a few days. It is that oil could remain above $100 or closer to $150 for years if the conflict continues. That would hit lower income households the hardest because energy takes up a larger share of their monthly budget. But the damage would spread far beyond the gas pump. High energy prices affect agriculture too. Fertilizer is tied to natural gas. If energy prices remain elevated, fertilizer costs can rise, food production becomes more expensive, and grocery prices can climb even higher. That adds another layer of inflation pressure to a system that is already under stress. This is why so many analysts are comparing today's situation to the 1970s. Back then, oil shocks helped trigger a brutal period of inflation, weak growth, high interest rates, and economic pain. The danger today is that we could be heading into a similar setup. Energy disruption, rising inflation expectations, government debt problems, weak bond demand, and geopolitical conflict all hitting at once. That does not mean history repeats perfectly, but it does mean the risks are real. The biggest danger is not one single event. It is the combination of events. Oil prices rising, Treasury yields climbing, foreign buyers selling debt, the Fed expanding its balance sheet, inflation expectations surging, consumers weakening, businesses slowing, major financial institutions warning that the system is under pressure. Each one of those problems is serious on its own. Together, they create something much harder to control. And that is the real warning. This is no longer just about oil. It is about whether the US economy can handle another inflation shock while debt levels are already at record highs and the bond market is already showing signs of stress. If oil keeps climbing, if Treasury demand keeps weakening, and if inflation expectations keep rising, the Fed and the government may be forced into choices they do not want to make. That is when this crisis could move from a market scare into something much bigger.